Welcome back to our intermediate financial accounting class and to our special lecture on time value of money. Now, we've already talked in the earlier segments about what time value is, how interest works, and about the basics that we need to gather in order to do a time value problem. We also went through some examples of what's a present value, what's a future value, and now it's time to do some actual calculations. Let the fun begin. We're going to start out by going through those four problems that we've already looked at. So we already know present value, future value. Now we're going to do the actual calculation. Let's take a look at the first one. Joan's grandpa, remember, promised her $20,000 when she graduates from college. We want to know what that's worth in today dollars. So to do that, we're going to start out by gathering some specific information. First thing we want to know is the type. And we've already said that this was a present value problem because we want to know what the value is today. The other thing we want to know is if this is a lump sum or an annuity. And the answer to that is a lump sum, because he's only going to make a payment once. If he was going to pay her $5,000 a year for each of the 4 years she was in college, then we'd have an annuity, 5 specific payments. Next, I need to know the interest rate. And we said there were 4 different things we could call the interest rate. We could use market rate, effective rate, discount rate, internal rate of return. Here's our discount rate, 12%. This is the interest rate that he or she, we're not sure which, Joan or her grandpa is doing this calculation, but that's the rate that this individual uses to decide what money is worth for them. And that 12% again would include the inflation rate, it would include the pure rate, and it would include the risk rate. Next, we need to know the N, and N will be the 4 years. And then we need to know the principal, and that's the $20,000. And the last thing we could gather would be the interest payments, but there are no payments here because he's just going to make the payment once. So this is nothing. So now that we've got all the information, now we can do our calculation, and the basic equation looks like this. The present value is equal to the principal times the present value factor of n periods at a given rate. If you're using a financial calculator or you're using Excel, if you gather this information and get this equation ready to go, then you can just type it into Excel or into your calculator, it pops it out. If you're using the tables, like we're going to have to, then you have all the information you need to go to the table and get the factor you need. So in this case, we want the present value. The principal is the $20,000 that Joan's grandpa is going to give her. Often you'll see this referred to as the face value. Present value factor, our N is 4 and our percentage is 12%. Now we're going to take this information and go to a present value table. And the reason that we needed to decide whether it was present value or future value, lump sum, annuity, is so that we know which table to use. So let me switch to my browser where I pulled up all of the different time value tables, and we're doing the present value of a lump sum. So right up here, present value of $1. And our N is 4, so we're going to go down to N of 4, and then go across to 12%. So right here, 0.63552. So this is going to become 0.63552. And if I multiply that out, I get $12,710. Now, if you've done that with the financial calculator or Excel instead of the tables, your number may be a couple dollars different. That's just rounding. It happens. It depends. Excel is probably the most accurate of the versions that we've talked about because Excel rounds out like 20 decimal places. Most financial calculators go out 10 or 12, and then the table we're using only goes out about 5. So of all of the methods, the table is probably the least accurate, and your financial calculator or Excel will be much, much closer to an unrounded value. And that's all there is to it. Once you gather that information, the equation is very straightforward and simple. Let's take a look at the next example. In this case, Adam purchased a new TV for $5,000, put it on his credit card. If his interest rate is 20%, not bad for a credit card actually, if he makes no payments and has no fees or anything, how much will he owe in 5 years? So we said this is a future value problem because we want to know what he's going to owe after 5 years. It's also a lump sum because it's only a one-time payment. He's not making a series of payments. It's just a one-time purchase and a one-time payoff that we're looking to figure out right now. All right, next thing we need is our interest rate. And in this case, our interest rate is going to take a little bit of work. The annual rate, remember interest rates are always annual, is 20%, but this is compounded quarterly. So we're going to divide that by 4, and it's going to compound at 5% per quarter. So that's the interest rate we're going to use. And he's going to pay this off supposedly in 5 years, but we're not interested in years, we're interested in periods. So my N is 20. My principal is the 5,000, and there are no interest payments. There's interest accruing, but he's not making any payments, so we won't worry about that part. All right, now I have all the information that I need. Hopefully this piece and this piece makes sense. Again, interest rate is annual. If I'm going to pay it quarterly, then it's being compounded, so I take the full annual amount divided by the number of compounds per year. That gives me an interest rate per period. And then I take the number of years times the number of payments per year, and that gives me the total number of payments or periods that will occur, or in this case, compounds that will occur between now and when he supposedly settles off this debt. So again, future value problem. Principal is 5,000. Future value problem, not an annuity, so just a basic future value. N of 20. Interest rate of 5. So we're going to go to our future value of a lump sum table to find this amount. So let's see, I'm on present value of $1. I want future value of $1. So that's right here, future value of $1. And we're looking at 20N and 5%. So right over here, 2.65330. So I'm going to take this back and put this in right here, 2.65330. And if I multiply that out, I get $13,266. So by waiting for 5 years, instead of owing $5,000 on his new TV, he's going to end up paying a whopping $13,266 for this new television. All right, let's take a look at another one. Joan won the Georgia lottery, pays $1 million a year for 20 years. Joan's going to save these payments and then wants to know that amount that she's going to have at the end of that time. So the type, we already said it was future value because we're saving each of these payments. And this time we're saving specific amounts. We're saving a series of $1 million payments for 20 years. So this is actually an annuity that we're going to save each period. 3%, and it looks like we're making payments in annually. No information about any of the compounding, so we're not going to worry about dividing by anything. I mean, you can divide by 1 if you want to. Anyway, our N is 20 years. Our principal, now we don't know. What we have instead are a series of payments. Not interest payments specifically, but payments. $1 million. So let's set this up. The future value of this annuity will be equal to, in this case, the payments. We've said interest payments in the past, but really it's any kind of payment, and this is a series of payments made by the lottery. Future value of an annuity factor is what we're looking for. N and a given percentage. Same basic setup. Payments here are $1 million that she's going to put right into the bank. N is 20. 3%. Let's go find our factor. To do that, again, we're going to switch to our browser and we're going to find the future value of an ordinary annuity. That's what we're looking for, not an annuity due, but an ordinary annuity. Remember, that means payments are made at the end instead of at the beginning. So we're going to find 3%. We're going to go down to 20. So 26.8704. And if we multiply that out, we end up with 26,870,400. And if you used a calculator, you probably got something closer to 375-ish. because it's not rounding it. Once you know the key information, it's easy to slip it into this equation because the equation stays the same. Let's take a look at one more. Lindsay's thinking about buying this annuity. She wants to know if it's a good deal or not. Type, we said this was present value, and it's going to pay $35,000 a year for 12 years, so that's an annuity because multiple payments of the same amount are being made. Interest rate is 10%, and we're not going to have to adjust it because they're being made each year. So again, we could divide by 1, but it comes out the same. And N is 12. We don't have a principal value again. What we have instead are a series of payments. Not necessarily interest payments, but payments nonetheless. So now that I have my basics, present value of an annuity is equal to the payments times the present value of an annuity factor n at a given percent. Payments are $35,000. N is 12, 10%. Let's go get our number. So again, we'll go back to our tables, and we want present value of an ordinary annuity. Now watch out. There are also annuity due tables for present value. Matter of fact, I've got another one over here because we'll use it later. Make sure you don't get annuity due when you've got an ordinary annuity. This assumes that payments are made at the beginning. An ordinary annuity assumes that payments are made at the end. And that's typically when payments are going to be made almost every time. So let's see. In this case, we've got 12 and 10%. So we'll scroll over here. 6.81369. And if I multiply that out, I get 238,479. And there's my value. So from Lindsay's perspective, if she can buy it for less than that 238, it's a good deal. If they're asking 240, then it's a really rotten deal. Even though $35,000 a year for 12 years looks like $420,000, when you throw in that 10% interest rate that she could make somewhere else, she'd be better off investing her money in something else if it's more than that 238. And that brings us back to the difference between accounting and other business leaders when they're making these decisions. You see, business leaders use time value calculations to decide whether or not they should make an investment or to decide between investments. That's what business leaders are doing with time value. Accounting, we assume the decision's been made. We're making journal entries based on the decision, and that's what we use time value for. So it's a little bit different. Now, since we know the concept, we can certainly help out with that first bullet. We can help make those decisions. But from the financial accounting perspective, what we're trying to do is make the journal entries that record the decision that's already been made. Now, the good news is, if you're still a little hazy on, is it fair value, present value, 99% of the time is going to be present value in business. And we talked about that a little bit before, but just be aware. Investments are being made today, journal entries are being made today, so 9 times out of 10, even more than that, 9.9 times out of 10. In business, we're looking more at present value than future value. Wow, we've done some fun examples, we've talked about some cool stuff. When we come back, we'll start looking at another unique present value problem that we deal with in business all the time. It gives us some great practice of some general principles and also gets us ready for some things we'll do in our accounting class. We'll see you then.